Welcome to the Wealth Horizon podcast, where we explore the latest trends, challenges, and opportunities shaping the financial industry today. In each episode, we bring you insightful conversations with industry leaders, sharing practical, actionable strategies to help advisors deepen relationships and meet growth goals. I hope you enjoy. Hi, everyone, and welcome back to the Wealth Horizon podcast. We are back from a long summer break. I hope you all got to take a summer break as well. I'm very excited today for the kickoff of season 2. Today, I am joined by an industry legend and also my friend, Jamie McLaughlin, the founder and CEO of J.H. McLaughlin Co, a family office consultancy working with both firms and families for more than 30 years. And he's also one of the co-founders of the Ultra High Net Worth Institute. Jamie is a nationally recognized thought leader and recipient of the Family Wealth Report's Lifetime Achievement Award. He recently authored A Cautionary Tale: The Challenges of Serving the Ultra High Net Worth and Centimillionaire Client Segments, a piece that highlights both opportunities and risks for firms looking to move up market. So today, Jamie and I are going to look at the gap between the marketing ambition and the operational reality. So Jamie, welcome to the show. Thank you so much for being here.
Well, it's a pleasure being with my friend, Rosemary Denney.
First I just want to open it up and I want to sort of set the background. I would say from my work, I've been in this industry for more than 20 years. From where I sit, I'm going to call it the past 5 to 7 years. We've seen a trend of firms who are looking to go up market, so to speak, right? So start to dip their toe in the water of serving the ultra high net worth market. We've seen some of this fueled by M&A, but I'm curious to know why you think all of a sudden this segment of the market is so appealing to firms and what you're seeing toward it sort of like industry wide.
Well, we have to look at it from the evolution of the industry. Let's take the very biggest view, maybe a 40-year view, where there has been a secular shift in demand. And so we had a business model that was largely the distribution of product, and it was investment product entirely 40 years ago, to the evolution of wealth management, where we were still largely, mostly because of the asset-based fee model, but we were still largely in the distribution model. Wealth or non-investment services were used as a basis for gathering assets. Again, I'm not being cynical, but that was the model. Well, the demand shift has been for counseling, and the counseling largely is integrated. The integration model is a new idea, may still be an aspiration for many firms, but is an important change in demand, that there are multidisciplinary, multifunctional, non-investment and investment requirements that are interdependent now being delivered. So you have that shift, but there's a second force that's at work. Whatever your political stripe, there's a concentration of wealth that's going on. Certainly in the Western democracies, particularly in North America and specifically in the U.S. And therefore, there are just more households that are wealthy. There are many more. Well, all tubs have risen. The CAGRs on that, compound annual growth rates on that, are about 5% total households. But it's expected that the forward demographic household propagation rate will be over 10% for households with $100 million or more. So it's an extraordinary concentration of wealth demographically that's going on. So the evolution of the industry is occurring where there's a demand shift and we have many more households. And so it's not a zero-sum game. And many firms believe that's a market opportunity that they should be capturing, exploiting, adding. And depending on the models, there are many different variations of how successful they have been or will be.
Hmm. And I would say too. So in addition to the increase in just the numbers of wealthy families, there's also, like as you said, those services, those integrated services, they're also sort of dripping down market, right? So they're also coming into the high net worth segments of the market. They're becoming a lot more commonplace, even in the more mass market and mass affluent firms. So I think it's kind of spreading both ways, but you're seeing an increase in the number of centimillionaires, ultra high net worth segment. And so you're seeing firms sort of say, okay, I want to, and maybe they're already serving that client base, but they want to scale that side of their business and then move into that market more aggressively.
Yes, but I think part of the underlying idea for the cautionary tale thesis and article was that I think for many firms that effort is misplaced, that there should be a caution that they may be giving something up, or they may be trying to do something that's much harder than I think they may at first glance recognize. And what we don't know with the assertions that they provide holistic, comprehensive, integrated family office services, those are buzzwords, by the way. You see them riddled on everybody's website. What we don't know is what's the quality of that advice. What level of experience, tenure, and prowess do those firms and their advisors that assert to provide this integrated advice have? That's the challenge, and it's challenging because clients, with some exceptions, clients generally are not able to discern between the quality that's being offered.
I'm curious to know what you think is the motivator for firms to really look at this segment of the market and say, okay, we're gonna move from our bread and butter, which has been sort of serving a more mass affluent. What makes a firm really want to move into this marketplace, considering the complexity and just the infrastructure needed to serve these clients?
Well, I think there's one primary motivator, and that is that they believe they can make more money. I'm not being cynical, but I believe that incentives, compensation, and various incentives of ownership do dictate behaviors. So it's inescapable. And by the way, that doesn't necessarily make it bad, but I think there's an economic motivation. I think that is completely misplaced, almost sophomoric, because it's really hard to do this. You have to have a lot of discipline, a lot of intentionality. You have to be very strategic. With, no disrespect, most firms and certainly their leadership, most of whom are client facing, are very, very busy, tend to be very tactical. There is not a lot of intentionality except to do good work for their clients, which of course we want to praise them for, but not as a business. Have they been generally in this G1 industry? Have they been intentional and strategic? And when they are not, they do the service for the ultra high net worth at their peril. They will do it at less, there won't be margin in delivering this because the incremental needs, time and effort, capacity utilization, and headcount, all three of them, are going to be higher on all three different measures. And that has to be, it is inherently dilutive of what they are doing in terms of their current business, unless they adjust their pricing model. And the industry has stubbornly kept to the asset-based fee. The asset-based fee, should they deliver all of these additional services, should they assume all of this expense profile that's additional, it will be margin eroding for an asset-based fee. It's one of my assertions. I mean, it's kind of an odd thing that delivering non-investment services and having a price for those non-investment services that is of a retainer nature, the building blocks being that there is consideration commensurate with the value rendered rather than an asset-based fee, is actually a defense, a prophylactic is what I say in the article, against the loss of the pricing power that you would get by just delivering the investment service or just delivering the combined integrated service on an asset-based fee. So there is a real way to do this and maintain margin, but you've got to change your pricing model.
Which really, I think, sort of implies a change, not just in the pricing, but the entire business model, right? So, like the entire business model has to shift to accommodate for that service and for the pricing. And in your paper, you do talk specifically about the margins and how the margins are often quite a bit lower for the firms who are serving the ultra high net worth market versus the high net worth market. Can you talk a little bit about those specific
Sure,
margins?
sure. Maybe to put some context into it, only because I replayed it and found it fascinating. And it wasn't the last quarter, but I think it was the quarter ending in March. Morgan Stanley's wealth management units, and they've got a number, threw off period over period margins over 60%, narrowly high margins, even for the warehouse or brokerage model, which tend to be around 40% plus. So it's a great period. Also takes into account the 23-24 capital markets assumption, but that notwithstanding, 60%. So in the article, I cite that margins in this group of firms that work with the ultra high net worth have been largely stuck in the 15 to 25% range, and good performers are doing in the mid 20s. Now, there's some firms, clearly there's some firms that are getting through the magical 30% margin number, which is a good number, but not many.
Right. And I think that that's sort of a misconception by a lot of firms that they're going to be able to scale up. They'll be able to make a lot more with their revenue for serving these ultra high net worth clients. But I know that that's incredibly difficult to do.
But let me add one thing. I think it's the insidious part of how this works. Assuming you're doing good work, virtuous work, and you're doing it at a high quality, it requires people. 65 on the low end to 80% of the expense profile for these firms are people. But when you're bringing on people that are doing the non-investment requirements for planning of a variety of planning requirements, they may have advanced degrees and credentials. They are expensive. The insidious part of adding those people is they tend to be underutilized. So their capacity utilization is less than 100%. So a very expensive person with low capacity utilization is extremely hard on a full-time equivalent, fully utilized basis. That's where margin goes.
Mm-hmm. And I'm wondering, in your opinion, is that where outsourcing comes in? You know, a lot of the firms that we work with, they talk a lot about integrated service. They talk a lot about family office services, but a lot of times they work with outsourced, sort of as needed, best in class providers, right? So attorneys, accountants, and peoples of the like, they will tap as needed.
I can commend all of them to continue to do that. Part of their charge, in the case of the RIA or independent non-depository trust company, part of their charge as fiduciaries is their duty of loyalty, and to the degree they can use that level of due diligence in their discovery and providing solutions. Should they not have the best-in-class person for that set piece, why would they not find outside of their core staff an adjacent partner with whom they can outsource? That's the best practice. And it may be during an interim period as they develop the people, whether they're developing them internally or bringing them in externally and adding them to staff, that they have a very proficient person that they can partner with, and that they've used their due diligence to find the best person. That's the model. You have to commend them for doing that, but it takes discipline to do that, and it requires them to recognize that they're not doing that partnership with an adjacent partner at any loss of primacy. Getting the first call is what primacy is with their client, and it's certainly achievable. It's the best practice.
Okay, but I have to ask you, Jamie, and just tell me your gut reaction. Tell me, do you think that for these firms who decide to outsource the sort of higher level positions versus firms who decide to hire them internally and who can offer all of those resources internally, do you feel that there is a loss of appeal for an ultra high net worth family when they're looking for a firm? Do you feel that there is any loss of appeal for those firms who decide to outsource versus, having all that staff internal for the clients to access? Do you feel like that's sort of like kind of makes them look not as attractive?
Perhaps, perhaps. But when you combine the virtue of serving your client with the economics of delivering these solutions, I think pragmatically something has to give. And to the degree that any one of these people with real prowess, lifetime experiences, they're expensive. At any time that person can be embedded into the P&L, it would be your preference, but that comes with some economic expense. And those are things that firms have to weigh. The alternative, of course, is time and the ability to develop and breed these people internally. And the industry, I think, is really focused on that right now with mentoring, formal mentoring and training and development programs, where a lot of work is being done to support people that may be younger and very competent with their credentials, but simply need to have more time in role working in an applied setting. And mentoring and training and development programs are unfolding right now across the industry. And therefore, the potential to breed that next generation is certainly one of the outcomes that I think we're going to see. We just don't have enough of them right now across all of the requirements. I mean, there's a real talent shortage in the industry right now for the aspirational integrated advisor. It's a really rich topic that the Ultra High Net Worth Institute is really examining, trying to define, and then trying to set standards for in terms of what we as an industry need to do to meet that challenge.
I mean, I see it even just in my own work, right? So having to carve out a message and help a firm define what it is that they're doing without looking like you're trying to be something that you're not, but at the same time displaying the robust service offering that you're giving to clients. It's a really fine line and not a difficult, not an easy thing, not an easy needle to thread, because they're grappling with that themselves internally. Like, who do we hire internally? How do we price for these services? Traditionally, when you're looking at the pricing that's based on assets under management, they don't take into consideration the added staff, that added overhead. So it's definitely a complicated conundrum for them.
Well, one comment, we should be careful in looking at the economics of our head count, to try to look at it, and I think to just make it simple, there are people that are client facing. They can be rationalized against the revenue or load that they bear. There are other people who are not client facing. You use the term overhead, to which there really is no offsetting revenue. They look like a cost or an expense to the business. It's in that regard that the overhead charge then might be allocated against the entire remainder of the P&L. And so I would say that on a capacity utilization measure, those client-facing people can become more productive. They can have greater unit productivity. They can be more efficient in terms of the total number of people and how they manage their load. And so there are ways, I think, for the client-facing group to actually mitigate against what your reference was, that there would be this overhead. And so I look at fixed cost for overhead for non-client-facing people and the client-facing people as sort of two different buckets. One is much more controllable. The fixed cost is less controllable. And what you do in response to that is you just don't deliver on your promise of doing something. So you almost have to have some minimum level fixed cost to deliver the solution. Last point, so I think it's important. Again, it's a wonderful discussion, I think, that the Ultra High Net Worth Institute is engaged in really for some time. And that's the issue of collaboration. So many clients have outside professional advisors. They have multiple advisors. That does not mean that they work together in harmony nor seamlessly. And the development of primacy being in the wealth management industry has been 25 years in coming, but bringing together outside professional advisors whatever their role, but we often talk about the tax advisor, the legal advisor as primaries, but there are many other people that touch the client. Bringing those people all together in harmony to have this notion that they collaborate is not a natural act, and it requires an individual of some stature to be able to control that group and create this level of harmony and collaboration to deliver integrated services. So think about it. Collaboration is different than integration. Collaboration is a mindset. Integration is the number of services one can deliver.
Two different talents, I think, right? To be able to play nicely with someone in the sandbox versus what you're offering your clients.
So I think the industry is evolving in that regard. I want to make it really clear. It's my bugaboo. I don't mind sharing this openly. I do searches for families, super wealthy families, and in the RFI or RFPs, we often ask about their compensation models, and compensation models vary widely, and compensations models that dictate certain things cause behaviors to be different. And I don't want to get into the sort of the bowels of how the compensation systems work. But if the compensation dictates you gather assets for a fee, you'll gather assets for a fee. If the compensation dictates a good behavior is to provide collaboration and integrated services, you'll do that and you'll be rewarded for doing that. But the early stages of compensation systems that support the latter are just that. They're early. And the thing that can equalize that and bring those people into a competitive market with people that have been historically paid to gather assets, the key is ownership and providing some kind of a profits interest to individuals. An ownership level really does have the ability to create better behaviors.
That's an interesting thought. I'm curious to know, this is sort of where my role kind of threads the needle, and I sort of find myself in conversations sometimes that I'm like, you guys should probably sort this out before you call me. But I'm curious to know how you think the marketing narrative for a firm, their public messaging, their value proposition, how is it, or how do you see it disconnected from their operational their sort of operational reality?
Well, one of the, when you boil it down and the pricing work I've done and a pricing article I did about a year ago, I think I mentioned it earlier in our conversation, there must be consideration commensurate with the value rendered. One of the things that the industry struggles with is what is their value rendered? And to state that you do things, which people do on their websites, and we have these buzzwords, comprehensive, holistic, integrated, you know the words, family office services. Everybody provides family office services all of a sudden. They ring really hollow to me. They're not even believable. So I know there's some shortcomings, and those remain largely aspirations. But what I think the sort of the industry is settling into is that there are some people that can actually deliver these solutions. Those people tend to be relatively expensive. And so I think we're going to see a separation of firms that are perhaps in the short term investing in their business by investing in their people. And through that investment, discerning families will see that qualitatively certain firms, in fact, can deliver on that promise. But I think it's still early. I consider the firms in the ultra high net worth segment a category. I am somewhat categorical about it and try to define who they are. But we have a group of 100 to 125 firms that are of some modest scale that I think I can categorically say exist today. And a group of that 125 plus firms are emerging as mega firms. They're beginning to scale to levels that we would not have seen before. and significant, $100 billion plus AUM firms, many of whom are using pricing models that capture additional revenue beyond the assets under management. And those firms are scaling at rates now that appear to be sort of pulling away from the pack, a group of 8 or 10 firms, not just with M&A, but because of their organic growth. And in combination, I think we're starting to see some firms of some industrial quality that have made the investment in their staffs and should enjoy, because of that investment in this short-term period, some margin expansion as they scale. Last point on that, because it's a really neat idea. Just being big is not necessarily better. So let's be careful about that. In fact, at last year's Ultra High Net Worth Institute Collegium, the sort of the main theme was, can you maintain client intimacy while being bigger? Can you scale and be a scale disruptor? Meaning, can you be very intentional about how you maintain client intimacy while you grow big? But generally speaking, bigger is never better, almost ever, in terms of maintaining client intimacy, unless you're extremely rigorous in your reason for being, your vision, your culture, your values, and the nature of which you have a North Star around which you always, as a beacon, adhere to. And there are some firms that I think can do that, scale, maintain that vision, and actually deliver on client intimacy. And that is a work, literally, that's playing out right now in the industry.
And I think that it becomes very obvious. I mean, from my perspective, I see it a lot. When a firm is so focused on M&A, they're so focused on gathering assets. They're very focused on their growth. They're very focused on scaling. They're very focused on, getting more and more families. The clients can sense it. They feel that they are no longer the focus of the relationship. They're no longer the focus. The primary focus of that business is day to day. And I think that, I don't know whether or not that
Mhm.
will play out with the loss of clients yet. I don't know. But I certainly see it in some of the firms that come across our path.
It's really rich. That is a really rich idea. Rosemary, that what you observe, and I think we together separately observe, is that there's something, for the lack of a better term, I refer to it as relationship capital. The firms that have relationship capital have it and maintain it. It doesn't, and I don't, for the audience, everyone may not be an investment banker doing M&A, but for those firms that are doing valuation and look at a fairly straightforward discounted cash flow method for valuing, and then look at a run rate, what the bankers would call a run rate on that cash flow, the normalized rate at which that firm will grow in the future, they really can miss the notion that there are some firms that enjoy relationship capital, and that two run rates are not equal when one firm enjoys a deep and profound role in an individual family's life, and their dependence on that firm is extremely high. And it's the right word. And the joy that they get because of that relationship is real. And I think it has an intrinsic value. It might show up in the rate of client acquisition, and therefore, if you have higher relationship capital, you have a lower cost of client acquisition because your clients are so thrilled that they promote you. It may show up in that number, but I think it's much more of an intrinsic value that occurs where, again, lack of a better term, where there is virtue between the firm's objectives, their shareholders and owners, and what the employees and clients all get together. And those firms that are maintaining that relationship capital are really maintaining this client intimacy, and there's a value in that. So threatening that relationship capital is actually a risk for the firm. It may not be an immediate risk economically, but I think it ultimately is an economic risk too.
Mm-hmm. And I'm with you. I'm looking at these firms that are growing to 100 billion plus, right? Aggressively growing bigger and bigger. How can they maintain that family office feel that ultimately made them successful in the first place? I'm just curious to see how that's going to play out. Were you going to say something?
No, I think let's be careful when you say play out. I think that's about the right term. Using an American baseball analog, we're not even in the middle innings in this shift. And we'll see some continued shifts where I think demand is going to drive this to have the models that are more enlightened, the staff configurations in the individual teams with higher levels of prowess. But it's still really early. I think we need to make sure it's clear that this profound shift is occurring, and it's still really early.
And that's where we'll pause for today. Thank you for listening to episode 1 of season 2 of the Wealth Horizon podcast. Stay tuned for next week when we continue our conversation with Jamie. We'll explore what ultra-high net worth families really value and how firms can authentically communicate their value proposition. Don't miss it.